Hi, good afternoon. It's my pleasure to welcome our next presenter with Bloomberg and BloombergNEF to be specific. But I'm also excited to have Bloomberg as a sponsor of this event that we're doing here in Dallas and online. So certainly appreciate their support. I'm joined today by Zeph Lokhandwala with Bloomberg and Nat Ballard, who's the Chief Content Officer for BloombergNEF. And as you think about Bloomberg, there's a lot of there's terminals, there's news. BloombergNEF is kind of the leading provider of primary research on clean energy, advanced transportation, digital industry, innovation materials, and commodities. And so we're quite lucky to have Nat, his thoughts, his expertise here. And we'll spend the next little bit getting Nat's perspectives, and then there'll be a little bit of dialogue between Nat and Zeph, and we'll get some questions from the audience. So I would encourage you all to submit your questions as we go through here, and we will have some time to get to that. But Nat, I will turn over to you.
Thanks so much, and thanks everybody for having me here. It's good to be joining you all at EnerCom Dallas. So, I run a presentation once a year that's my sort of global stock take on the things that I think are most important happening in energy in general, but also sort of more specifically energy transition, thinking about how far it's come to date, where it might be going, and what the paths are within that might impact companies, sectors, and industries. And so I've got an excerpt here of this big piece that I do every year with a few other adders to kind of highlight where we are in energy transition today and where we think that might be going. So I'm just going to hop right in and look forward to taking questions after this is done and after my colleague Zeph and I have had a chance to chat too. So the first thing to notice, we've tracked investment in this sector for about 15 years. If I think of energy transition writ large, it's about movements within electricity, within transportation, and increasingly within the world of molecules, right? Within the world of not just providing electrons and not just putting those electrons into transportation, but doing other things around the world of chemicals, around the world of fuels, and the hard to decarbonize, hard to abate sectors. And what's really interesting to note is at first, we're at about $500 billion a year worth of investment in these sectors. Secondly, there's something interesting happening in electricity, which is as a function largely of technology improvements and falling costs. We invest about the same amount now, about $300 billion a year that we did 5 years ago, which means that all the growth in the dollar terms is actually happening in the side of transportation. And in the future, maybe some of that growth will be happening in other things like hydrogen or carbon capture and storage. But at the moment, we sort of see this interesting tension on the invested dollar between what's happening in the world of infrastructure and electricity and in the world of transportation, which is now up to about $150 billion a year. We can blow that up a little bit, though, and look at capital markets in general and just see what's happening in the world of sustainable finance and in particular sustainable debt. This is a sector now that was just under $750 billion last year. But importantly, it's also increasingly diverse. I mean, if we went back and did this 10 years ago, we would just be talking about green bonds, really specific instruments tied to a specific asset or maybe within a specific company. We now have social bonds, we have sustainability bonds, we have loans as well, green loans and sustainability-backed loans. The field is widening, the field is growing at the same time. We'll probably see $1 trillion invested year on year within a year or two to go. Look back into capital markets too, and actually last year in particular, the green bond market pretty much outperformed the global bond market benchmarks. So there's an interesting case here where investing in this portfolio would have done you very well, and it's also something that there's a great deal of interest in originating on the side of companies that are looking to go green in terms of what they finance and in terms of what they do with the capital that they've raised. We should also think about the world of disclosure and the world of reporting, where that's going. So the TCFD, the Task Force on Climate-Related Financial Disclosures, has grown to the point now where we're in the range of almost 1,700 companies that support this, and governments as well included in that group. But these are all institutions that are looking to standardize the way that companies and any institution really talks about climate-related risk in a financial context. Really important for us to see how this evolves over time and how it standardizes. I happen to sit close to a couple of these efforts, both internally and externally. And what I can think of with this is that the long-term glide path here is to looking something like gap accounting, something like generally accepted procedures for how we talk about and how we codify climate risk. Let's look at technology for a minute too. So underpinning all of that first slide, all that $500 billion a year in energy transition investment, is the fact that technologies have improved massively, right? The solar panel that increasingly many of you probably, if you haven't seen, you might already have on your roof, is something that improves about 28.8% every time the total capacity is installed is doubled. And it does double in not too much time these days. This is a decrease in cost of about 99% over the last 45 years, and also an increasing efficiency and an increasing quality. I mean, this is, for those of you in the world of technology, the sort of things that you're probably not unfamiliar with. Things get cheaper and they get better at the same time, and in that process, they create their own market. You can say the same thing about the lithium-ion storage battery. This is probably, after solar and after the wind turbine, the big thing that's starting to really be transformative in multiple ways and in multiple sectors, right? This is the battery that powers a Tesla. It's also the battery that supports an electricity grid. It's also the thing on which people are building new business models to better run a grid without peak power, to better optimize around faults, to better provide frequency control, to manage variation and that sort of thing. It's the sort of thing that has a path that, to me, as an analyst, looks very familiar from what happened in solar. So that gets cheaper, that gets better, and that in the process starts to make its own markets. We should put that in the larger context of the auto market itself. So no secret, I don't think, that it was a fairly dismal 12 months in the global auto market in 2020. COVID took a big bite out of the market, obviously. But it's important to note that new sales of autos were already trending slightly down. In fact, 2014 was the peak in trailing 12-month terms for global auto sales. And this figure here is pretty dire if you look at it just from a manufacturing perspective, but we should take a cut into there that's curious, I think, for the way that we're going to talk today. And that is to look at what happened in electric vehicles. So we saw 3.1 million electric vehicles sold last year, about 4.5 million that are going to be sold this year. And the reason I highlight that is, obviously, this is an outperform, right, in absolute terms, that this market grew significantly, even in a year when the rest of the market did not. Another way to look at it, though, is to sort of reference this chart to my previous one. The electric vehicle manufacturing part of the global auto market is the only part of the growth in the market, right? If the market as a whole is shrinking and electric vehicles are growing, they are growing within a shrinking market. So you have a sort of outperforming capability in terms of how much of that global market share is being eaten up. It looks like we could be in the range, of this year, somewhere around 4.5%, maybe 5% of all auto sales are coming from electrics. I know that's still not a huge number, but it's way far away from where it was at the beginning of the decade. And a lot of what goes on there too is just improvement, right? I keep talking about things getting cheaper and they keep getting better. Well, that's, if you look at the electric vehicle, that happens as a reference here in range. Like, this is what EV model ranges look like for European, for Asian, and for US manufacturers over time. And basically, they've gone from being runaround vehicles for town, with a few exceptions like Tesla in the early days, to now being something that provides, I would say, most of the driving duration that most people need most of the time. We'll have to wait and see how this trickles out behaviorally, but it could end up being more like almost all of the driving distance demand that people have almost all of the time. It really is a behavior thing that we're going to see as it shakes out. But I want to close back up with a little bit more about money. So, when I look at energy transition and think about how it's going to be funded, I can look back into all of that capital coming in the sustainable finance market. What's interesting here to note is that, look, the numbers are all big. And the energy sector itself is a reasonably big borrower in the world of sustainable debt, but it's by no means the biggest. And what we're seeing primarily is that most of the capital is being raised for sustainable transition, if you will, from institutions that are not actually in industry itself. So we need to watch very closely and see if, say the energy sector is able to sort of move its way up in terms of total capital raised, or if it's going to be essentially not at the mercy of, but dependent upon the way that other sectors raise their own sustainable capital. You can also think about this in terms of fund inflows. Like, we monitor at Bloomberg quite closely what happens with ESG fund inflows. And what we're seeing is that, just a real skyrocketing interest in this capital. And so, this is not huge by any means. We're talking in the range of a couple of $100 billion that are in ESG focused mutual funds. But it does have a way of taking up oxygen, right? And wherein funds are flowing in and people see that they're performing well, they want to put more money into it. And the question again is how can this get attached to you, right? How do companies attach themselves to this trend if this is a viable route for financing their transition? The circular economy, I think, is worth noting too, because it was one of those things that took a big hit during the middle of COVID, right? Investment in the circular economy, and that's very relevant for oil and gas companies in particular, and thinking about products that can basically be used and then reused ad infinitum, did take quite a hit early on, but actually that funding has come back. And so again, how do you think, how should companies think about their ability to attach to the trend in circular economy financing, how they might use it, what they might need to provide to become part of that is worth us asking. And a final couple of slides here. First of all, I just want to look at public opinion. I know here in the United States, we tend to get very caught up in kind of edge cases within the news. But it's worth noting that within the US and globally, the idea that climate change is a major threat is really not really up for a huge amount of discussion. Here in the United States, we're sort of the lowest of most of the big countries, at about 62% of people that think that it's a major threat. Other places are much higher, like more than 70%, approaching 80%. And that's, I think, very relevant towards looking at global markets. This is not really something that is up for debate, or rather, if it is up for debate, it's not up for debate within a particularly large proportion of any given economy. That's on a population basis. Now, it might be up for debate on a particularly large proportion of sectors within an economy, but we should think about, the people living and breathing within these societies and what they think and how that might impact the future path for companies and for different sectors. And then finally is this. This is probably the most extraordinary thing to my mind that came out of 2020, which is in a year in which governments could have made any movement that they wanted, essentially, to move away from a long-term path towards sustainability with COVID as a cover. We saw, in fact, quite the opposite. We saw that at the beginning of 2020, about a third of all countries in terms of total emissions had said that they were going to institute some kind of net zero target on their economy by 2050, or in the case of China, by 2060. And by the end of the year, it was more than 50%, right? So we saw countries, partly thinking of a way of building back better, partly a way of becoming more resilient, but also partly just saying that the near-term impacts of COVID did not by any means derail people's long-term thinking about what a really deep decarbonization could actually look like. So I think that's where I'll stop for now. I'm going to take my slides down and look forward to a conversation with Zeph, and then with any questions that come from the field. Thank you.
Sure. Excellent presentation there, Nat.
Thank you.
Just wanted to touch on a couple of things. So let's talk about some of the strategic rationales for companies doubling down on their energy transition commitments in 2020, and also how do they pay for this stuff? I mean, let's look at the majors, right? Let's look at the Exxons of the world. They've committed a 3.8 billion-ish dividend per quarter. About 15 to 16 billion is going out the door right now just in dividends. In a 50 billion cash flow world, they could easily spend another, say, 25 billion on regular oil and gas capex projects and still have some money left over. Right now, it's a negative cash flow situation. They cannot cut their dividend. They have to rebuild their balance sheet. They're basically borrowing money to maintain dividends. So, this year is probably not going to make much of a difference. It'll probably be at least next year in a world where oil prices are probably more like 70 to 80 for them to be able to even have the capital to make any real commitments. And then we're looking at, there are a lot of SPACs in the VC space. I mean, there is a ton of money available for experimentation. I look at the TAN ETF, for example. A substantial number of those people are not going to make any money for 5 years. So, let's just talk about, in terms of the majors, it seems like capital is constrained. Most of the E&Ps in a similar situation. They all want to transition. How do we fund this stuff without going and borrowing a lot of money?
So it's been, I mean, like there's a real split between the majors, right? I mean, like the US majors and the European majors are taking fundamentally different paths on this, right? I think that We should probably look at this strategically before we look at it in terms of how the capital is going to be raised. So strategically in Europe, the Europeans have said, we are going to be doing this, but it's largely because there's a huge amount of interest from their shareholders. And there's also a huge amount of pressure on them within their home domains, or within Europe in particular, saying, look, these are paths that we are committing to and probably best to be aligned along them. In terms of the capital raised, I mean, everybody's become a little bit more capital efficient in the last couple of years. Most of the European majors swear up and down that they will be able to do the energy transition investments that they want at an acceptable return on capital. I think the thing that's really interesting to me, though, is to see how much that return on capital has changed. You know, the expectation for that return on capital was now in the range of 8 to 10%. That's their stated goal, which is not what you would have seen, say, 15 years ago in the oil business, but it's also better than current reality for a lot of companies. So, you know, maybe part of the funding is to sort of peg the companies at what they expect to be a kind of lower for longer return on capital world. You know, here in the United States, I think it's a little bit more complicated. You know, we don't have a policy yet that is imposing this demand on any of the companies. Shareholders' primary concern seems to be dividend more than anything else, rather than growth. I mean, in many cases, it seems to be the dividend that is the paramount priority. And so I guess the question is going to be like, would a company impair its dividend or signal that it's going to change that approach to then reinvest money in something that might be trending it more towards growth? I mean, that's a really good question. On the E&P side, you know, what I'm curious to see is how a company might make a play in the world of sustainable finance by making a commitment and financing it through the world of sustainable debt, if one was inclined, right? There are companies that can hive off part of the operation and saying, let's fund it doing this way, right? Definitely, we're seeing companies make commitments around reducing flaring, you know, maybe taking responsibility for some small part of their total emissions, like Scope 1 or Scope 2 emissions, and seeing how the capital markets treats it. I mean, the big challenge is that, right? We know this is going to be, if we have a high oil price, does it throw everything else out the window, right? Or does it make these commitments? Does it make these commitments easier to do at the same time?
Yeah, and there has to be some the regulatory pressure, I would assume. In Europe, they have that pressure.
Right.
In the U.S., the Biden administration is not talking about any kind of, cost on emission of carbon. So they're doing it through ITCs, PTCs, and so on. So they're incentivizing investments. But on the other hand, the growth days of E&P companies seem to be over. Investors want back, return of capital. Nobody expects them to be able to grow and flip to a major anymore. Those days are gone. The private equity firms lending to them so they could go and prove reserves and sell for a bigger price, all of that is gone. Now they have to live within cash flows, which only increases the pressure on them. It makes it harder for them to go invest in new things unless there is a quote unquote tax on it.
I think that's fair. So that's why I was sort of like, I'll dive back in a little bit deeper on my thing about maybe, if not funding one's full transition, right? As an E&P company going to then suddenly become a developer of wind farms, right? Are you going to go the route that Vicky Hollow at Oxy has said, where you essentially become a carbon management company, right? You're producing it and then you're managing it towards end of life as well. Not every company can do that, but you can make commitments within oil itself and within gas itself. You have the lowest emissions from production, right? You have the most measurement and verification of any flaring, of any leaking, and you're doing your best to minimize that, right? Those sorts of things, I'm noticing they're beginning to become part of company pitches for acquisition within the oil patch. And are they going to become more robust over time? I would imagine that that's possible, right? That companies are saying, we're going to distinguish ourselves by measuring better and managing better what we have measured over time.
Yeah, I mean, I would argue Oxy is in a very unique position because their asset base allows them to do that. Not all E&Ps can do this, right? Because after you go through your primary recovery, you go through water flooding and all secondary, and then you go to tertiary recovery with carbon dioxide type assets. Some of the majors have it. Some of the guys in Canada, for example, have it. But the average typical E&P doesn't have a whole lot of EOR, enhanced oil recovery, CO2 type assets. So it's harder for them to have this carbon neutral proposition. So Oxy is, I think, unique. It's hard for others to replicate that.
I agree completely, right? Like that's why I said they've got a whole life cycle within their business, right? Contained within their business already. They wouldn't have to be not building something from absolutely nothing in order to do that.
Yeah.
But yeah, if you're an E&P, you can begin with measuring as best you can where you are, right? Like making this a priority that is transmitted to investors.
Yeah.
Then beginning to manage within that, right? And I think we may see some companies decide that they could be more aggressive about their aspects of their emissions or their methane targets than others, right? And that is something that in theory the market might reward over time. Is it going to be enough to put a pure play E&P into a sustainable bond index? I don't know, but like this is a case where the bond, the sustainable bond market or the sustainable finance market is booming. So try it out. This is a place I think where we will see people trying that. We definitely see it in Europe. We've seen green bonds raised by some of the European majors for specific sets of renewable assets in this case. But I think that we'll see that being tested. At the same time, we're seeing an increasing sophistication within the sustainable debt market as far as measuring what exactly counts as sustainable debt, what actually counts as a green bond. So you'll have a sort of tension between both, but that they both mitigate towards better measurement, managing what you've measured better, disclosing it very well, probably signing up in many cases to some kind of longer term protocol, and sharing the best practice within that allows people to get the best understanding of where progress is being made.
Yeah, absolutely. And these are all excellent points. I mean, in terms of sustainable debt, there's definitely a lot of debate about how many so-called dirty people are pretending to be green to get some cheap financing. And, that always happens in this business. And metrics are very important. And, metrics have improved in recent years. E&P companies have done a great job of like pad drilling, for example, reducing particulate matter by spraying water on the roads and so on, and just reducing emissions. They've done a lot, and ESG scores have improved. Unfortunately, at the same time, oil prices fell. So those improving ESG scores didn't appear to have any correlation with stock performance, both on an absolute level or on a delta level. So that's been the conundrum for ESG investors. It's like, how do you actually make money using this stuff?
That's right. No, I agree with that completely. And again, if we see a higher price scenario for a while, how is that going to impact people's plans, right? Do you just essentially reverse everything you've previously done, or do you find that these commitments are counter-cyclical and they're worth maintaining, right? There's something that's worth doing to sort of either ride through and keep up if times change again, or they're just something structural, right? They're not counter-cyclical; they're a structural change that you want to make in the business. Should we grab some questions from the floor? Have we got any from anybody else here?
Yeah. Hey, great presentation. I do have a couple questions, and I'll let you guys keep going through. The first question here is taking a look a little bit more at the global side of the energy transition. You have countries like Germany burning more coal than they ever have historically. We've got, maybe other nations that are still burning dung. How does that play into the energy transition and maybe some of the molecules that we're seeing come out of the Marcellus at some of the lowest carbon intensity? And what are your thoughts there, and how does that play into an overall transition component for a global market?
So if I follow that correctly, the question is basically like what's the what's produced here in the U.S. is in many cases some of the lowest emissions and definitely some of the best verified molecules anywhere. Where are those going to go? Well, there's not a lot of substitutability between what's happening in the Marcellus and what's happening in Germany necessarily. Germany's got some LNG imports, but a lot of what it's going to be importing is going to come from Russia. That's a German decision that we won't impact. Germany's coal fleet, and look, the power fleets in pretty much all of the world that we see developing outside the United States have a big challenge, which is that the competition for the marginal electron is basically going to be between something happening in renewables and coal. It puts gas in a kind of a tight spot in a lot of markets, right? In particular, in South and in Southeast Asia, the competition there isn't intermolecular. The competition is between renewable electrons with no fuel and between coal. And what we're seeing too is that there are concerns beyond just the absolute lowest price level for electrons playing into this, in particular in places where there is still coal development being planned. I mean, Karnataka in India just decided that it won't be doing any more coal development, right? There are states that are making decisions, not at the national level, to say that we're not going to be doing this. One other thing to bear in mind is that wherein states import coal, they still have some exposure to trade flow, and there may be some interest in, onshoring as much as possible all of the energy production that can be done. So, I mean, it's a bit of a complex answer, but the one-line version is that the long-term competition that we see almost everywhere outside the United States is between renewable power generation and coal in the power sector, not necessarily between coal and gas. There are plenty of places, of course, where gas is still booming. We've got a lot of U.S. LNG exports, but that, like on the 2050 view, is where most of that competition is going to happen.
And maybe one more, just to build on that a little bit more on the commodity and where you guys are seeing this mix. One question here around, lithium batteries and greater efficiencies in the future, tied to, what some folks here in Texas experienced, the renewables being able to be a reliable member of the utility power mix. And how do you see in the near term that changing, and is it a need for technology step changes, I guess, or are where do we get there?
So again, the question I suppose is like, is there a reliability issue that needs to be met? Well, there's a couple of things. Like reliability, I always think of as a grid-wide function. So reliability is probably best distributed throughout the entire grid. I mean, of the multiple issues that occurred in Texas in February, the issues arose, I think, largely at a system level with a series of cascading system level failures. So, things need to be done to improve the system writ large. But within that, there are probably a lot of applications that if you aggregate them can make that improvement, right? We would not have had a battery application that was going to ride through a week of blackouts at 0 degrees Fahrenheit in Texas. Now, there are plenty of places that manage to keep power fleets running quite fine with a similar power mix, even more renewables, all gas in some places that are running quite fine at those temperatures, but they have to be prepared for that purpose. For the battery applications, I think what we're going to see that's very interesting is the tension between one technology, the lithium-ion storage battery, continuing to attract in a sort of virtuous cycle fashion, more investment, therefore become cheaper and more reliable, and then watching its sort of application set expand because of price. This is something as well that happened with solar in a similar fashion, is that it began with kind of on the margin economics, outcompeting in specific applications and things like that. As it became much cheaper, it sort of becomes the default setting, even if there might be something that is theoretically, from an engineering perspective, better. They become more efficient from a capital perspective, essentially. So what are we going to see? What kind of battery applications are we going to see? Are we going to see people build batteries to meet the use case that would have saved things from 2 months ago? I think that that's going to be very challenging to do. The economics of that, I don't think necessarily make any sense. Are we going to build applications that allow us to better ride through a number of not quite as severe issues? I think that will probably be the case, but that needs to be that's not a thing that needs to take place at this sort of renewable power developer or storage developer level. It needs to take place at the system of systems level. Like, it needs to be not just ERCOT and the RRC. It needs to be then working in tandem with the PUC of Texas as well, and to work in turn with developers, with people doing planning and permission, to kind of ensure that this sort of thing never happens again, and work through all of the things that need to happen to do that, rather than just getting sort of piecemeal solutions.
That makes sense. Switching gears a little bit to the funds flow side of it.
Sure.
Question here of the observation of a lot of the funds flows have come in for these green bonds for renewable types of deals. What is the catalyst to include maybe a natural gas or some of these broadening of what a green bond really is? What are some of the catalysts that you see on the future that may happen
in the future? I mean, I think the tension is going to be between more and more people wanting into the category for every good reason, and a sort of enhancement of what people generally accept to qualify as a green bond or not, right? I mean, in the past, we've seen certainly green bonds applied for emissions reductions of specific kinds. Like, would we see something qualify as a green bond if it attaches to, over the lifetime of the security, a complete decarbonization of an activity? Maybe, even if it starts with something that's higher carbon. I mean, I think that that's certainly possible. But this is something that I think is very much in its infancy in terms of working out what's going to qualify or not. Those of you who have accessed the fixed income markets are well aware that it's pretty opaque a lot of the time, right? It's very OTC, it's over the counter, right? It's not being done necessarily in a way that we get a lot of visibility on. But that's what Zeph and I do. That's our job, right? Is to sort of monitor these things closely as we can, and to sort of get an idea for how that's changing over time. I don't think I don't know that we're actually going to get to the point where just there is a blanket exclusion on X from being a green bond. By the same token, I don't know that there's necessarily a blanket inclusion that we will have in the long run for a particular technology, a particular sector, or something like that. It's probably going to be trending towards better defined over time, but I don't think that it's going to be fully scoped like at any point in the next couple of years.
So we've got time for probably one more question, and then maybe other closing comments that you guys may have. Question here in and around, and it could be a similar answer, but the growing propensity for ETFs and passive money,
right,
in and around, maybe it's the green side of things, but ESG type of ETFs, certainly rapidly growing.
Yep.
Where is that money? Where are you guys seeing that money come from? Is it primarily U.S. driven, European, or both? And how has that market change here in the near term?
A good question. Unfortunately, I don't have a lot of deep insight on the specifics of where those funds are flowing from. But I mean, generally speaking, it's U.S. and Europe. There is some representation in there from Asia, but most of that fund flow is happening here. The question is, I think you're right, is what is it flowing out of? I mean, it's not a huge amount of capital flow at the moment. You can see it's in the range of under $10 billion a month. The average for 2020 was just under 4.6 billion a month. So, it's decent, but it's not by any means hollowing out like the world's mutual fund and ETF market. But we need to see how much bigger that's going to go and how much more that too is going to get defined. I mean, one of the things that I was interested in noting last year was that there's actually a kind of an inverse correlation between the size of the asset manager and the amount of proxy voting that it does on behalf of environmental things. So, some of the world's biggest asset managers had, relatively speaking, some of the lowest amount of proxy voting in support of sustainable or climate-related initiatives on the part of their portfolio companies, even though they may have made a statement that they were going to be doing more and more and more of that. Largely, that's a function of scale. It's also a function of this being relatively new. But I'm curious to see how that plays out as well, right? Like just as significant as ramping up fund inflows into specific ESG mutual funds will be, just bearing down on companies or investing institutions' own stated positions about proxy voting around climate issues or around sustainability issues. So that's one to watch very, very closely. It's a small incremental move within a much bigger total market could end up being equally or even a good deal more significant.
Thank you for that. That leads us to time. Is any closing remarks from Zeph or Nat that you guys want to leave us with?
Zeph, you want the last word? I mean, I'm all good. Everybody's heard enough from me, I think.
I think it's definitely a very exciting transition going on. As Roger Reed mentioned earlier, we've had other hopes and dreams with nuclear in the 40s and 50s. So, that didn't work out. It became very expensive to make it safe. So it's, we definitely have the potential of a once and maybe 5 generation change, but it's not going to be easy and it's going to take a lot of money.
That's right.
It is going to take capital. Gentlemen, thank you very much for your time, your expertise, and your thoughts. We appreciate our relationship with Bloomberg and look forward to continuing to have a discussion with you all. I would encourage, if there's any other questions that we didn't get to, I'll make sure they get in front of these folks as well and they can follow up. So continue to put those into the discussion box below. And gentlemen, we'll let you have your afternoon.
Thanks for having us.
Thank you.